So by breaking down the various parts of the property into theoretical lifespans, it creates depreciation schedule, accelerated depreciation. And what that creates is an unrealized loss, and investors can then get that unrealized loss on their K1 and apply it directly to their investment into that deal or into any other passive income that they have, or even capital gains. They could apply against capital gains if they'd like to.
Talk about you guys' strategy with accelerating depreciation, doing the bonus, right? And what that looks like if someone were to put like $1 million into a deal with one of your deals, either through the fund or through the syndication. Who wants to take that? Who wants to take that one?
I'll take that one. I talk about this pretty regularly with investors. I'm assuming your listeners know what accelerated depreciation is or a cost segregation study is. I'm happy to break that down if it's helpful. But
Just do it quickly, yeah, help, yeah.
So it's basically a study done by an engineer that breaks the property down into different parts of lifespan. So HVAC, 15 years, roof, 15 years, maybe some part of the utilities, 7 years, siding, 20 years, whatever it might be. So by breaking down the various parts of the property into theoretical lifespans, it creates depreciation schedule, accelerated depreciation. And what that creates is an unrealized loss, and investors can then get that unrealized loss on their K1 and apply it directly to their investment into that deal or into any other passive income that they have, or even capital gains. They could apply against capital gains if they'd like to. So it's a really nifty, exciting part of multifamily. I'd say it's probably, in my opinion, 50% of the attraction because it's amazing. So our average loss for the first year of accelerated depreciation, born from these cost segregation studies, is 30 to 60% of the investment. So if someone were to put in $1 million into one of our deals, they're looking at 300,000 to 600,000 of loss for year one that they can then apply to either the distributions they received from the deal they invested into with us, or to capital gains if they sold the deal and they don't want to do a 1031, or to any other passive income they have. And then that depreciation schedule, winds down over the years of the ownership. It diminishes. So the year one is really where you get the best bang for your buck.
Absolutely. And then you get the law of compounding interest in, right? We call that tax flow, compounding interest, eighth wonder of the world, with the cash flow, with an appreciating asset that's stable, that's consistent, that's multifamily. I mean, gosh, Glenn, it feels like, what else do you want in an investment, right? When you've got all those things going for you in a group to work with you like that. I mean, what else can a guy ask for, Glenn?
More. Actually, it's pretty good. It's very good, and we're proud to be in it. And sometimes when the investors receive the first year's loss, the first reaction is, "Oh my God, how did we lose money?" And then when they understand it, they're very appreciative that they don't have to pay any tax, right? Until we ultimately sell, then you balance out.
Yep.
That's where you come in, right? You help us at the exit.
Yeah, sometimes, right. It's a good point, because you go, well, when do you pay the tax, right? Well, eventually you can get recaptured, right? Depending on when you sell and what the nature it is and how long you've had it. And this is where we can come in. And as long as your debt is not above your basis, is the key thing here, everybody. That's the key. Make sure you're making your debt flow, tax flow, and your cash flow. You're balancing those things out. Upon exit, we can defer the capital gains tax and the depreciation recapture. A little caveat though, if you're doing that accelerated, which is what we're talking about here, and depending on how many years you've held for, there could be some what we call slippage, where some of that it's not deferrable with the deferred sales trust, because you're changing the nature of 1245 versus 1250, which is a technical way of saying it may not be deferrable. However, you could buy another deal, let's say with Glenn, through the trust as well for the other part that is deferrable, through an LLC, which gets a new depreciation schedule with Glenn and Colony Hills Capital here. And then you're working another cash flow scenario. So it's almost like you're trying to create ownerships and also, unrealized loss positions, right? So that every time you're collecting either cash flow or taking capital gains tax, you are building a capital gains tax exit plan for and tax and cash flow plan that's offsetting, right? And so it's this balancing act. This is part of why you want to build a team. This is what we do here at Capital Gains Tax Solutions. Yeah, you can go to capitalgainstaxsolutions.com.